For so many of us, tax season it feels like trying to find your way through a thick, foggy forest with no map. But what if I told you there's a clear path right through the middle of it? In this explainer, we're going to walk that path together, step by step, and demystify how your taxes actually work. So let's kick things off with a pretty wild statistic. Nearly 90% of all taxpayers take what's called the standard deduction. I mean, it's the easy way, the simple road. But here's the big question. Is the easy path always the one that saves you the most money? The answer to that could literally be worth thousands of dollars to you. Okay, so every journey has to start somewhere. And for us, the starting line is the most basic question of all. Before you even think about forms or software, you have to ask, do I even need to file a tax return in the first place? Let's figure that out. Whether or not you have to file really comes down to three main things: your filing status, your age, and your gross income. And as you can see here, for most people, you have to make a decent amount of money before the IRS wants to hear from you. But then you see that last line. If you're married but filing separately, you have to file if you made just $5. No, that's not a typo. 5. It's basically the tax code screaming at you that it wants married couples to file together. Now, your filing status is the foundation for your entire return. It sets the stage for everything else. It determines your tax rates, your standard deduction, the whole shebang. For most, it's pretty simple. If you're not married, you're single. If you are, you're probably filed jointly. But that head of household status, that's a really valuable one for unmarried people who are supporting someone, and it can save you a lot of money. All right, now we're getting into the real core of your return. We're about to talk about the single most important number in your entire tax life. Seriously, this one number controls almost everything that happens next. It's called your AGI. AGI, or adjusted gross income, it's pretty much what it sounds like. You take all the money you made, your gross income, and then you make a few key adjustments. Just think of it as your financial starting point in the eyes of the IRS. It's the number they use to decide which tax breaks you get and which ones you don't. And the formula itself, super simple. You start with on your income, and then you get to subtract a special class of deductions called above-the-line deductions. And let me tell you, these are the best deductions, because you can take them even if you don't itemize later on. We're talking things like contributions to a traditional IRA, interest you paid on student loans, or money you put into a health savings account. So if you remember one thing from this whole explainer, make it this. Your main goal every single year should be to get your AGI as low as you possibly can, legally, of course. A lower AGI doesn't just mean less taxable income. Oh no, it's the key that unlocks the door to all sorts of other amazing credits and deductions down the line. It really is the ultimate gatekeeper. And speaking of deductions, that brings us to the biggest fork in the road on our tax journey. This is a decision pretty much every single taxpayer has to make, and it's where that 90% number we saw at the beginning comes right back into play. Okay, so you have two ways to reduce your taxable income. Path number one is the standard deduction. It's a simple, fixed dollar amount, no receipts, no math, no questions asked. Path number two is to itemize. That's where you add up a whole list of your specific, eligible expenses. The standard path is easy, for sure, but the itemized path, that's where you could save a lot more money. And here are the numbers you're up against. Just find your filing status on this chart. That's your target number. Your only job is to figure out if all your deductible expenses add up to more than that number. If they do, you itemize. If they don't, you take the standard deduction. That's it. It really is that straightforward. So what kind of expenses are we talking about here? Well, the big ones for most people are home mortgage interest, any donations you made to charity, and your state and local taxes, though remember, those are capped at $10,000. And check out that medical expense deduction. The bar's pretty high. You can only deduct the amount that goes over 7.5% of your AGI. See, there it is again. Another perfect example of why getting that AGI down is so powerful. And you don't have to take my word for it. This quote from CPA Viola Robinson Faust nails it. The standard deduction is all about simplicity. Itemizing is about optimization. Your job is just to run the numbers and see which path leaves more cash in your wallet at the end of the day. All right, we've lowered our taxable income with deductions. Now it's time for the real magic. I want you to think of tax credits as the power-ups in the game of taxes. They are way, way more valuable than deductions. And this right here is the absolute key difference. A deduction just lowers the amount of your income that gets taxed. But a credit? A credit is a direct dollar-for-dollar reduction of the final tax bill you owe. So $1,000 credit saves you $1,000, period. $1,000 deduction might only save you a couple $100, depending on your tax bracket. It's not even a fair fight. One of the biggest and best credits out there is the Earned Income Tax Credit, or EITC. It's designed to help out low to moderate income workers. And what makes it so incredibly powerful is that it's refundable. That means if the credit is worth more than the tax you owe, the IRS doesn't just wipe out your bill, they actually send you the rest of the money in cash. I mean, just look at how valuable this credit can be. We're talking over $7,000 in some cases. But look at those columns on the right, max AGI. There's that number again. Your eligibility for this game-changing credit is completely controlled by your adjusted gross income. This is the perfect aha moment that shows you why getting your AGI down is the name of the game. We've made it. We've gone through all the tough calculations and the big decisions. We are now officially on the final leg of our journey, actually filing the return, and, just as important, knowing what to do if you hear back from the IRS later. So if you're waiting on a refund, listen up, because this is a total no-brainer. E-filing with direct deposit is the way to go. You'll usually get your money in under 3 weeks. But if you mail in a paper return, you could be waiting 6 to 8 weeks, or honestly, even longer. Okay, now, deep breath. Getting one of those official-looking envelopes from the IRS can be pretty scary, I get it, but you really don't need to panic. A lot of the time, it's just an automated notice, something called a CP-2000, which usually just means the income numbers they got from your employer don't perfectly match what you put on your return. It's often just a simple data mismatch that needs clearing up. The key is just to handle it calmly and with a plan. First, read the notice carefully to see what they're saying. Second, figure out if you agree or disagree. And third, just send them a written response by the deadline. And here's a pro tip. Always send copies of your documents, never send your originals. You follow these steps, and that scary letter just becomes another task to check off your list. And there we have it. We've finished the journey. We went from the starting line all the way to the finish. And hopefully you've seen that the secret to taxes isn't just about filling in boxes on a form. It's about strategy. It's about lowering that AGI, making the smart choice on deductions, and finding every credit you deserve. That foggy forest? The path should be a lot clearer now. So the only question left is, what's the one thing you're going to do differently next tax season?